Hi, welcome back. Today we're going to talk about another hot topic that's going around right now, and that is the headlines that people with good credit are going to pay more for their interest rate, or they're paying the difference for people with worse credit. And there's a
Yes.
lot of misinformation out there right now, and a lot of people that are having conversations about it that maybe don't have all the information that they need. So we just wanted to jump on here real quick to be able to clarify that for some of you guys and to just add some value there. So Nicole, why don't you tell me a little bit about one, what you've been hearing, and two, kind of the truth behind the LLPAs?
So, yes, the sensationalized headline around this is that those who have more money and better credit are paying too much, they're paying more, or they're paying for those who have less down and lower credit. Now, for all intents and purposes, there's some truth to that, but it's all in moderation. So it's a perspective, right?
Right.
LLPAs did change. LLPAs stands for the loan level price adjustment. Those LLPAs are specific to the calculation of an interest rate for somebody who's getting a conventional loan. So a Fannie Mae or a Freddie Mac loan, not a jumbo loan or a high dollar loan, and not a government loan, an FHA, VA, or USDA loan. This is simply going to be the Fannie Mae and Freddie Mac loans. There is a grid. I don't want to overcomplicate this because it can get complicated really fast. So I'll just
Sure.
keep it somewhat simple. There is a matrix that determines based on your credit score, based on your amount down, and then you also have adjustments for the property type, if it's an attached or detached, and if it's what the property use is. Is it a primary home, a second home, or investment property? And then what you're doing with it. Are you purchasing it? Are you refinancing it, or are you cash out refinancing it? All of those adjust what your final interest rate is. The loan level price adjustments that have been under debate specifically is the grid that brings together the credit score and the amount down. The same credit score for different amount down will have different LLPAs. The same amount down for different credit score will have different LLPAs. Therein lies the crux of the issues. Is if I had a good score and I was putting 20% down, my loan level price adjustment did get worse. It did. If I have a low score, putting the same 20% down, my LLPA, my loan level price adjustment, got slightly better. They didn't flip flop. The lower credit score or the less money down didn't get a better rate than somebody that has a better credit score or more money down, but they started to condense. The best scores got a little bit worse and the worst scores got a little bit better.
And so when you're talking about a little bit, what does that mean for a buyer? Like, what are they realistically seeing as far as a difference?
It could be an eighth in interest rate.
Okay. And it's the
Yeah.
cost of that rate, correct? Like how
It
much it
is
costs for them?
yes and no. So the cost for that rate is what changed,
Right.
but most people will simply get the par rate, the whatever that rate is that has no cost. So for most buyers, it's going to translate to my interest rate just got an eighth worse or an eighth better based on what I was theoretically quoted. Now the problem is rates change every single day, sometimes multiple times a day. So you can't really say, well, my interest rate got an eighth worse than what I was quoted right before the change. And we can talk about dates here in a second. Or you can look at it from the other side to say, well, I was paying a point to buy down the interest rate to this number that I wanted, that interest rate, because that interest rate got me the monthly payment that I wanted. And now that interest rate theoretically would cost me a point and an eighth instead of a point. So it could be in cost. More than likely, it's in rate.
Okay. And so are you seeing a lot of people that are having to buy down because of the difference, or is it really not making a huge difference for buyers?
It's not making a huge difference in the amount they're buying down because most buyers today are anticipating that we're going to have a refinance opportunity when rates do come down, when inflation comes down. So in that case, some borrowers are forced to buy down the rate because their credit score might not be as good or their situation creates an environment where there is no par rate. They have to pay points for that rate, especially if you're buying like an investment property or second home. But if you're not, you're probably better off going with the par rate and then refinancing it when interest rates do go down.
Sure. And you were talking about dates. You said you wanted to talk about dates. What do you mean by
Yeah.
that?
So a lot of people got very upset. And then I don't want to dismiss that. It did kind of come out of left field. And I do think really, I feel like the biggest change and statement that was made with this was the fact that now a an individual who serves at the pleasure of the president, the FHFA director, can make a determination on what Fannie Mae and Freddie Mac charge their lender partners. So this is new. We haven't seen a massive change to the LLPA grid like this, and certainly not by an FHFA director. So it did politicize hello, the situation that didn't have that aspect before. Now on the dates, so a lot of this came to light and in the news right before the end of April because of a May 1st deadline. So Fannie Mae and Freddie Mac had a deadline of May 1st that any loans that were submitted to them to be insured by them had to have the new LLPA adjustments associated with their interest rate if they were submitted after May 1st. Now, if you think about when can a lender send a loan to Fannie Mae and Freddie Mac, it is at the tail end of the process. So as a buyer, I go to a lender and I get pre-approved. And then I start shopping for homes. I finally get under contract. My loan gets disclosed. I decide to lock in an interest rate. It's another 30 days before I get to the closing table. I close on that loan as the lender. I get the documents back from title. That could take anywhere from a day to 3 days. And then I have to package that loan package and it goes to my post-closing. My post-closing does a quality control on it. And then it goes back and forth between if the buyer has to sign something in title. And then finally it gets to Fannie Mae and Freddie Mac. So it might be 6 weeks after you went under contract. So the interest rates didn't go up on May 1st. The interest rates were adjusted in the middle of March. So we had already absorbed the adjustment by the time everyone was talking about it. I know I do a weekly market update for real estate agents in the Denver market. We'd been talking about this since February, knowing that it was going to start impacting interest rates. And I don't want to dismiss the impact. It's real. It had already taken effect by the time people got very upset about it.
Right. And I do get it. I mean, it is a big change. And I think a part of it is, especially for people in the industry, is like we haven't seen big changes like that, like that big of a change. And so I think a lot of it is maybe just like the shock factor. But we also had the change with FHA loans for mortgage insurance and making that more affordable. Are you seeing more buyers considering FHA loans because of the changes in the LLPAs and the MI?
So it's interesting because both VA and FHA at the same time, this was originally announced. So this was originally announced from FHFA back in February at the same exact time that that FHA, government-backed loans, FHA loans came out saying that their monthly mortgage insurance was dropping. And VA came out at the same time saying that we're going to drop our upfront funding fee. So they dropped and FHFA improved. Same thing. The lower credit scores got a slight improvement. The higher credit scores got a worse improvement. So all of them tried to focus on that lowest end buyer, the buyer that might have the least amount of money saved, might have the worst credit score. They were all doing the same thing at the same time. Now, most of those people, if you have the lowest credit scores, you are going to go to FHA really no matter what. It is going to give you the best, and it was before and it is now. It is the best interest rate and the best overall solution because the private mortgage insurance did not get cheaper with this change. So the private mortgage insurance that goes along with conventional loans is still higher. So as a buyer in this group, FHFA, Fannie Mae and Freddie Mac, did something to attract more of those first-time home buyers who might be further challenged financially when realistically they're not going to get them anyway. They're going to go with FHA.
Gotcha. So not a huge shift there then, really. Okay, well, that is the nitty gritty of it. And we can kind of diffuse some of the talk now with the headlines. But appreciate your time, Nicole. And as always, if you guys have questions, please don't hesitate to reach out to us. And we'd be happy to help or add value in any way that we can.
Absolutely.